Eric Muadid, Muadid.com, August 12th, 2015. Let's take a look at the markets. Market's been open here for about 20 minutes and we are down about 1% on the markets here, the Dow and the Nasdaq. SP500 down 0.87 at this current time. So let's take a look at the charts to see what the charts look like and what they might be telling us. All right, so let's go to the Nasdaq on the weekly. And I think for this week we have to be very aware that if we move below 50 on the Nasdaq, on the weekly RSI, expect this to be an even bigger down week. So be aware, if we crack 50, expect this to be actually leading to a bigger drop by the end of the week. Also, we need to hold this line. Otherwise, a break of that line might really begin another, or might continue pushing this market lower. So I think the market is at a very serious standpoint here. It holds and everything is fine. It breaks and then there's reason to really start looking for the markets to go low. Take a look at the Nasdaq Daily. Also, if the market is to bounce, it needs to find a way to finally be above this green line with uniform activity. As an example of, just take a look at this double bottom on the line somewhere here. You got an odd looking double bottom there for this lows there. So this needs to hold. Otherwise, the more it trades below that green line, the more it opens the possibility for lower prices. Take a look at the Dow Weekly. And for the week, I think the best summary for how to approach this market right now is, as long as the Dow is trading down for the week, one has no reason to be looking for reasons to go long. The market has to show you something. And I think the best way we can actually confirm that the market can move higher is if and when the Dow turns positive for the week. So the more the market is trading down for the week, I suggest there's no need to try and find bargains. Let's wait for the market to turn positive. Otherwise, we might be caught in a major correction. You see here that there's this green line where the Dow has been bouncing successfully, pushing the market back to new highs over the last 2-3 years. Market's been holding at this range. Right now we are looking at the threat of this breaking down, and this is going to be a serious break if that takes place. Keep in mind there's also another level to watch, which is the 2015 weekly closing lows going back to, I think, February. If the market cracks below 17,164.95 on the Dow, right now it's trading just a hair above that. Moving below that to fresh 2015 weekly closing lows would actually suggest that now the market is starting to position itself to probably probe lower prices. So in other words, the risk continues more and more. The more we break lows that we haven't seen for this year, the more we break RSI support lines, things we haven't done in a long time, the more these things take place, the more the risk is to them for the market to trade lower and even substantially lower. Also, if we take a look at a fresh Dow weekly chart, we can see that right now the Dow is showing a crossover between the 13-week moving average and the 34-week moving average. That by itself is a major red flag, suggesting that this market could already be going into a bear market. Now, the last time we had the market have a crossover, let's go back about 5 years on the weekly. We can see here that the last time we had a crossover between the 13-week moving average and the 34-week moving average was here in late 2011. And since then, the market has gone on a major run. So right now we are looking at the potential for this, suggesting even lower prices in the coming weeks and in the coming months. We take a look at the Dow on a monthly chart, and this is where I've been saying the risk is this could already be suggesting lower prices. The more the Dow is trading at fresh 3-year lows, the more this is now more and more looking like we are entering into a major correction phase. So we have to be aware that the monthly here could be suggesting that the more the RSI is moving to fresh 3-year lows on the Dow, actually this is not a good sign. Also, we take a look at the fact that one of the MACDs already was trading at 3-year lows. So we have a MACD trading at 3-year lows, which is a second requirement. and this is not good because the 3-year move is also just now about to move below zero on one of the MACD time frames. So really the risk is that this could actually get worse. Is it going to get worse? We don't know that for a fact, but we know that the risk is this could actually deteriorate into a full-blown bear market. We take a look at the S&P 500 weekly, and we had discussed this on the weekend, or I had discussed this on the weekend. S&P 500 needs to hold above recent recent weekly closing lows at 2076.62. Right now we are trading below that number, suggests that it is now pushing to fresh weekly closing lows over the last couple of weeks. And again, as long as the S&P 500 is down for the week, I think we have to be very cautious and not look for reasons to buy any rebound candidates, because this might be actually suggesting lower prices. You'd like the market to confirm weekly RSI support before you can be looking for buy opportunities. Now, there's one thing I need to qualify this is right now we are looking at the Dow. I'm sure the Dow coming off the lows down about 200 points or so, 207 points, in that range. But what's really interesting is that even though the market is down, S&P 500 has yet, let me repeat that, has yet to break down on the daily. You can see the daily still showing that it could eventually see support on the green line. The daily showing that it could eventually see support on this RSI lows line. So even though the market is down, it has yet to break on some level. But let's be aware that the more it starts trading below these two lines, the more the risk is to the downside. Otherwise, if it holds on those two lines and starts pointing higher with a positive day, maybe a positive move on the weekly charts, then maybe we might be looking for reasons to go along. Obviously, many are watching how it responds to the 200-day moving average. Also, if it can hold the 200-day moving average, that's good. I think the key, in my opinion, is these two lines on the daily. This needs to hold, and also this needs to hold, those two lines. Otherwise, if they break and we trade below here, beware, this market might actually be ready to plunge. Now, other things that we can consider are the VIX Daily. So let's go to the VIX Daily, and the VIX, as of right now, let's get my daily chart. All right, so on the VIX Daily, there is a recent daily closing high on the VIX, and that level is daily closing high 15.60. The more the VIX can stay above that level, maybe there's downside pressure. But if the VIX is struggling to hold above 15.60, this recent daily closing high, if it struggles around here, then maybe the market is not set and ready to go down. That's one view. The VIX needs to start showing strength by moving above recent daily closing highs. And why do I say that? Is because if you take a look at even this period here, before the VIX moved higher, right here, before it moved higher, it had to take out this recent daily closing high. Even here, it had to take out the recent daily closing high before it had this move. So for it to move higher, it needs to take out this recent daily closing high. Right now, it seems to be struggling, which is probably a good indication of what the market could do, or is a bullish indication. Right now on the VIX Hourly, we also see that it's come back to a level where it's been stalling for quite some time, which is this line here. And as of right now, the VIX is trading exactly at the stall line. So if this is truly a period where the market goes down, then the VIX has to and must trade above the red line. Otherwise, if the red line is confirmed as resistance, again, then the market is a buy around current levels. We can also look at other charts for indication that the market is not necessarily broken. Take a look at the Dow Hourly, and on the Dow Hourly, it's coming back to the green line of support here on the RSI. Well, actually it's below that, so scratch that. It's actually coming back to the line connecting RSI lows. So it's coming back to the line where it bounced recently, and we are making lower lows in price, but the RSI seems to be improving, and that's not a bad sign if you're looking for reasons to be bullish. Also, one more reason why the market could hold is because as of right now, we are looking at markets making lower lows on the price, but the RSI on the 30-minute chart for the Dow is showing improvement over a period of time. So I think as long as that's the case, then maybe this market could bounce. But again, I go back to the weekly charts. As long as the markets are down for the week, be aware. As long as the Nasdaq is below 50 on the weekly RSI, this might be a down week, even with more downside. So be aware, if the Nasdaq is trading below 50 for the week, this market is not going to bounce this week. If the Dow is down for the week, be aware that there could be even lower prices. And also the fact that if the Dow cannot hold above 2015 weekly closing lows, right now it's trading below that range. If it's trading below or it's slightly above 17,164, if it cracks below 17,164, expect lower prices for the week. And also S&P 500, as long as it's down for the week, and also as long as it is below recent weekly closing lows of 2076.62, this market could see lower prices. So yes, some time frames are suggesting there could be a bounce, but again, the risk is that this market is starting to trade and have some bearish tone. So you have to find and see, you have to see convincing evidence before you can start looking for bargains. And the best way I would approach that is you need the market to be positive for the week, or at least to show a bounce on the S&P 500 daily with a daily positive move before you can start going long. In other words, this chart here needs to show support, and it also needs to show support on this line. And how can it show support? It can show support by being positive and confirming that it has bounced on the line. Two ideas, and they're not the best ideas just because of the way the charts are trading. EEV looks good on the monthly. If you're trying to short emerging markets, looks good because the monthly RSI is trading at three-year highs, which is what you want to see, which is good, right? So that looks good on the monthly RSI. MACDs are showing that they're also trading at three-year highs, which is good. So the MACDs are doing their thing and meeting the minimum requirement. That's not the problem. For my money, the problem here is the stock it's got a low daily trading volume. Average daily trading volume for this one right now is about 62,000. So that's the problem. Otherwise, the chart is okay. And if you're looking for a reason to short emerging markets, you can use this recent weekly closing high of 21.47 as your entry and your stop. So as long as it's holding above that, which is what it's doing today it's breaking out, this is a buy. Okay, if it moves back below 21.47, you can get out. So this is an idea. If you wanna trade emerging markets and you wanna short emerging markets, you can go along this instrument. It meets the minimum requirement as long as it's holding above 21.47, which is this recent weekly closing high. An instrument that moved in step with this one is the EDZ. Now, I don't like the 3 times bearish ETFs. They don't trade. And even though it looks great, you can see it's breaking out. Right now, the entry is, as long as it holds above this recent weekly closing high, and the level there to watch was 42.39, which is this weekly closing high previously. So right now it's a buy with this move. It's also pushing above 69.1 on its weekly RSI, which is great. Just to show you the MACDs and the RSI on the monthly, you can see trading at 3-year highs on the RSI, trading at 3-year highs on the MACD, which suggests that this is at the strongest technical level it's ever been. So it looks good. My only problem is that these 3 times ETFs just don't trade well. So if you're gonna choose this one and not take EEV, you gotta make sure you have a stop on this one, because when they start going down, they can drop 10-20% in a day. So that sets a risk. These ones don't trade well. The 3 times ETFs have been trading with take a look at how they lost gains here, lost gains here, lost gains here. So you have to be aware they don't trade right. So EEV and EDZ are the options if you want to go short emerging markets. Otherwise, I leave you here with the market down about 200 points. The risk here, again, in conclusion, and I have to stress this because it is absolutely imperative that we understand this. The risk is that on the Dow, it is starting to look a little bit bearish because the monthly RSI and the monthly MACDs are trading at 3-year lows, which is generally speaking an indication of an impending serious bear market. Eric Mother.com. As always, good luck, peace, and blessings. Woo! EACS.